Who are the victims? Everybody who has an investment in the stock market.
So let's talk about what Michael Lewis has actually exposed, why markets feel more chaotic today than ever, and more importantly, how disciplined investors can still win without trying to outsmart algorithms, institutions, or Wall Street. This has never been about fear, guys. It's always been about understanding the game that you're actually playing. Remember that famous Warren Buffett quote, "The stock market is a device for transferring wealth from the impatient to the patient." So guys, let's just say out loud what a lot of people are thinking right now. It feels rigged. It feels like every time regular investors start making money, something happens. The market drops 10%. Tech stocks fall 20% a week. Some headline hits, and suddenly your portfolio is red, while Wall Street somehow says they knew it was coming. You see hedge funds with supercomputers trading in milliseconds. You see politicians outperforming the market, and it creates this narrative in your head. The crash is manufactured. The system is built to transfer money from regular people to Wall Street and institutions. And when you start believing that, something dangerous happens. You either panic and sell, you sit in cash forever, or you start chasing really risky trades trying to beat the system. But here's the truth that most people don't want to hear. The market doesn't need to be rigged to take your money. It just needs you to react emotionally. And guys, I do not want you to be a victim. There's a process that works whether the market is rigged or not. I've been investing for over 25 years, through bubbles, through crashes, everything imaginable. I was around for 2000, 2008, COVID. And over long periods of time, I have done very well. And later in this video, I'm going to show you exactly what that process is. So let's assume, for the sake of argument, that the market is rigged, not in some dramatic sense of a bunch of guys sitting in a room going, "Let's screw Main Street America." Guys, it's not like this secret boardroom that exists where very few people decide how your portfolio rises and falls. You know how I know that? Go look at the returns of these Wall Street hedge funds and these banks when it comes to managing equities over a long period of time. Spoiler alert, they're shit. So when I say rigged, I mean it in a structural sense. Like you heard in the video, meaning the system favors speed. It favors scale. It favors institutions with better data, better technology, and better access. That part is not controversial. To some degree, that's just reality. High-frequency traders execute in microseconds. Algorithms scan headlines and react before you can even read the next tweet. Institutional desks can see order flow patterns that you didn't even know exist. So yes, if you're trying to trade short-term momentum, guess news, or react emotionally, you're probably playing a game where someone else has the advantage. And Munger always says, play the game in which you have the advantage. But here is the important distinction. The market may be rigged against speculators. It is not rigged against owners of great businesses bought at the right price. And that small difference changes everything. Because if you're not trying to win in milliseconds, if you're not trying to front run earnings or trade headlines, then you're not even playing the same game as the algorithms. You are playing the long game. And the long game still runs on fundamentals. And that's where we thrive. So before we go any further, let's talk about who Michael Lewis actually is, because this isn't some random voice shouting on social media, and many of you may not know of him. He's one of the most respected financial writers of all time. He wrote The Big Short, which is a complete story after the financial crisis of the few people who called the financial crisis. But you know what's interesting? Those few people were not major Wall Street banks. In fact, major Wall Street banks made fun of those people. He wrote Moneyball, which changed how people thought about data and competition in sports and in baseball. And he wrote the one we're most focused on today, Flash Boys, the book that shook Wall Street by revealing how high-frequency trading firms were exploiting tiny speed advantages to profit off of everyday investors. So to be clear, he's not someone who's anti-market. He is not anti-capitalism. He's against the idea of a structure that quietly disadvantages people who don't understand what's happening behind the curtain. When he said the market was rigged, he wasn't saying you can't make money. He was saying that the system rewards those who understand its mechanics and punishes those who don't. And that's where this conversation becomes important. Because the average investor, they're going to hear rigged and they're going to think, then what's the point? But a disciplined investor hears rigged and asks a better question. Which behavior is the system punishing and which behavior is it rewarding? So let's dive a little deeper into Flash Boys, because Michael Lewis didn't argue that the stock market was fake. He argued that it had become a race measured in these milliseconds with the goal of skimming small profits, but in such frequency that add up to big profits. In order before everyone else did, even a fraction of a second before, you can step in front of it and profit. Not millions per trade, pennies per trade. But when you do it millions and millions of times per day, pennies turn into billions over the course of a year. Now here's the part that matters to you. This wasn't about stealing your portfolio returns. It was about skimming tiny amounts from short-term traders who were constantly buying and selling. The faster and more emotional the trader, the more vulnerable they were to this structure. And here's what's important in 2026. Markets are even more automated now. Algorithmic trading dominates daily volume. AI models scan earnings releases instantly. Machines respond to keywords, guidance changes, and macro headlines faster than any human can even think to do. If you're trying to trade by the minute, if you're reacting emotionally, if you're changing price, you are already competing against the machines and you're losing. I'm not saying that there's no world where it can be done if you have a strong process, but the odds are not in your favor. Now, if you're investing based on business fundamentals over many years, not just minutes, you're not even playing that game. F that game. That's where we need to talk about who actually gets hurt. The people who get hurt the most in a rigged market are blind buyers. They're the investors who buy because price is going up and they only follow price. They buy because someone on TV sounds confident. Guys, I personally know one of the guys on CNBC, and when I tell you I wouldn't give him my worst enemy's money to manage, I truly, truly mean that. They buy without asking one critical question. What is this business actually worth? When you buy based on price, you're not investing, you're hoping. And hope is exactly what gets punished in markets driven by speed, algorithms, and extreme expectations. Think about what we've seen over the last few years. AI stocks trading at enormous multiples, crypto surging on narrative alone, companies doubling on guidance headlines, and people buying because they feel like they're missing out. FOMO. That is emotional buying. And emotional buying is exactly what algorithms feast on. Because when expectations get too high, it only takes a small disappointment to trigger selling. And when that selling starts, machines accelerate it. Not because they're evil, but because they're programmed to react to momentum. The blind buyer buys high on excitement. The panic sells low when the trend reverses. That's not a conspiracy. That is human behavior that has been going on since the beginning of time. But what's interesting is behavior can be oddly predictable. So here's the part that most people don't fully appreciate. In 2026, over half of daily market volume is driven by algorithms, not humans. Algorithms don't feel fear. They don't feel excitement. They don't care about narratives. They respond to patterns. They respond to order flow. They respond to momentum shifts. They respond to volatility spikes. And when a stock starts falling, machines don't ask, is this company still good long-term? They ask, is the trend changing? That's why pullbacks today feel so sharp. That's why earnings reactions can be so violent. That's why a stock can drop 8 to 10% on what seems like minor news, go back to even and then fall further. It's not because the world's ending, guys. It's because that large piece of trading has become non-emotional. And that ironically punishes emotional humans even more. If you buy because something is going up, machines will amplify that for a short period. If you panic when something starts falling, machines will accelerate that too. So your question should be, what does this mean for you? You need to recognize what's out of your hands. For example, you cannot control algorithms. You can't control the Fed or institutions, or if your stock rises or falls 10% any given day, month, or year. You can control one thing, the price you pay relative to what a business is worth. That's it. And fortunate for you, that's what really matters in long-term investing. Price is what the market shows you. Value is about the business and what it produces over time. Algorithms move price short-term. Fundamentals determine value long-term. And over the long run, not days, not weeks, many years, even decades, value always wins. I guarantee you that if you buy a business that generates real cash flow, has a strong balance sheet, durable demand, and long-term growth, and most importantly, you buy it at a price that gives you an ample margin of safety, you don't have to worry about short-term games because you're not trying to flip it. You're trying to own it. The rigged part of the market punishes short-term reaction. It does not punish long-term ownership. When you're not constantly trading, there's not much to skim off the top. And this is where emotional detachment becomes your edge. If you're attached to the price you paid, or if you equate short-term movement with being right or wrong, you're going to struggle, guys. Guys, look at other videos I've done where a stock I owned that was down skyrocketed. What do I say? Okay, it went up in the short run, but I don't know if it's going to go up. This doesn't mean I'm right. I will be right 5, 10, 15 years from now when my thesis plays out. If you can separate price from value, if you can look at a business and say the price is down, but the value hasn't changed and maybe even gotten better, now you're operating on a completely different level in the crowd. And guys, you're operating on a level that would crush Wall Street. So let me tell you something that changed my investing forever. The market doesn't care what price you paid. Those computers don't give an F what price you paid. It doesn't care that you bought at 150, now it's at 120. It doesn't care that you felt smart when it went to 170. It doesn't care about your entry point. It doesn't even know you own it. The only thing that matters is, what is the business worth today for you, themselves, as purchase price? That number becomes emotional. Guys, I'm guilty of it. Recently, one of the stocks I love, I thought if it's grossly undervalued, has skyrocketed. At today's price, it still looks like a really good deal, but I'm apprehensive. Why? Because in some way, I'm attached to that purchase price I made a long time ago. That's just as bad as doing it the other way around. Guys, that number becomes emotional, becomes an identity. If the stock falls below it, they feel wrong. If it goes above it, they feel right. That's ego. And ego costs you a lot of money. It's cost me a lot of money. Guys, here's a perfect example, and it's very recent. Meta fell from $340 per share down to $88 a few short years ago. People were not assessing the business. They were reacting to the price. They were saying things like Zuckerberg is done, he's to be removed, the company's finished, this is a falling knife, etc. That's what everyone else said. Guys, go look back at our videos about it. When I looked at it, I didn't see a price chart. I saw 3.5 billion people using the products every single month. I saw revenue was still growing. I saw massive free cash flow. I saw the fact, and I said this in videos, that in the US, Meta was making 42 or $43 in revenue per user. Internationally, they were like $4. And I sat there and said, that's only going to get a lot better. So I asked myself 3 simple questions that I always ask. Do I think this business will be around in 10, 20, 30 years? And my answer was an emphatic yes. Second question, will it have more revenue, more profit, more cash flow in that foreseeable future than it does today? My answer to that was yes. The third and most important question, could I pay a reasonable price for it today? Answer, absolutely. Guys, at some point it was trading at single-digit PE, but I want to remind you, I started buying it at around $200 a share and bought it all the way down. In fact, I actually got lucky and bought it November 4th, 2022, which was the day it hit $88 a share. Guess what? All the way down. People were saying, see, you were wrong. I never felt wrong. I just sat there and said, okay, it might take some time. That same company delivered 20% year-over-year growth in 2025. Even back then, it was growing every single year. It's hard for people who are new to investing to understand that Meta was $88, not $600 or $700 where it trades today. The price collapsing didn't scare me. It attracted me. That's non-emotional buying. No guessing the bottom. No being brilliant. Just separating story from fundamentals. If you can do that, if you can detach yourself from the price and focus on value, you stop playing the emotional game the market that wants you to play. And that's when you stop being vulnerable to the short-term movements of stocks. Now, let's bring this all back to present-day reality. A stock I like right now that I mentioned earlier because it fits my process, Southwest Airlines. I was buying in the mid to high 20s, even in the low 30s. Even though the stock is up now over $52 following a big earnings jump, I actually think it still looks attractive, but I'm attached to that price before. That is the anchor that I have. But you have to be willing to pay up as value rises.
In simple terms, one US dollar buys less, especially when compared to another currency, such as the euro. 1 year ago, the dollar and the euro were very close to parity. $1 would buy 0.98 euros. Today, a dollar buys 0.85 euros. The dollar's generally been declining since January 2025, when it closed above 109 and has recently fallen to a 4-year low, down roughly 11% over the past year. The dollar's been dropping due to fiscal concerns, monetary policy, political policy, and capital flows, especially with gold going up so fast. So here are 6 things to own or to be investing into in the event that the dollar does weaken even further. This is also going to hedge against inflation as well. So remember, we're talking about a dollar weakening. And so this is not just a portfolio that I think is just, always supposed to be the thing that you're supposed to have. But if you very much believe that the dollar is just going to keep weakening, then this is something to keep on your radar. And I'm not saying that you need to buy all these or invest in all these, but these are all things that would go up in the event of the dollar going down. So number 1 would be owning international stocks, and more specifically international ETFs. When the dollar falls, foreign currencies strengthen versus the US dollar. So your overseas investments get a currency boost on top of market returns. The ones that benefit the most will probably be European equities, emerging markets, and commodity exporting countries like Brazil, Australia, and Canada. Some easy ETFs to put on your radar would be VXUS, which is the total international stock market, VEA, which would be more like developed markets, and then VWO, which would be emerging markets. Many US investors, including myself, are very overweight in US dominant stocks. A weak dollar does flip the advantage overseas. But number 2 is still going to be US companies and US ETFs that win from a weakening dollar. And this is very much underrated and understated. And this is why in most of my videos I do explain that you don't necessarily need to be investing internationally. But again, for this video specifically, and if you do believe that the dollar is going to weaken, and it's going to weaken very much so, and also that it's going to increase the currencies around the world, and our dollar is just going to lose ground to those foreign currencies, then some exposure to that pure international is a good hedge. But here what I'm talking about is that all of our largest companies are globalized and they are multinational. Multinational companies earn revenue overseas and foreign earnings translate into more dollars. The sectors to really look at would be big tech, industrials, and consumer brands. Some examples would be Apple, Coca-Cola, Caterpillar, Microsoft, or just use VOO or VTI for broad exposure in the United States, or VGT for tech specifically. Now, number 3 is the one that's been very popular lately, and it's one that everyone talks about when hedging against a weakening dollar, and that would be gold. Gold is priced in dollars, and so when the US dollar drops, gold is worth more. So it's not necessarily that gold's actually increased in value, it's just that the US dollar is dropping. It's a little bit confusing there, but it's still a good way to hedge against that weakening of the dollar or even inflation. Why gold works is that it's a hedge against the currency debasement. The central banks buy gold when confidence in fiat currency drops. And this kind of happened in China, and especially around the world, but very much specifically China, when they're trying to say that we're going to get off of the dollar standard, or we don't believe in the dollar or want it to be as strong anymore, so we're just going to buy up a whole bunch of gold and go that route instead. And that's the reason why gold went up so much, but also partly the reason why the dollar's been dropping so much. Some options here would be GLDM or IAU for physical gold ETFs, or just buying physical bullion if you want crisis insurance. Now remember that if you're buying actual physical gold, yes, you do hold that gold, but there's also some cons involved with that too, like security and different things like that. So also, you want to keep in mind that later on, if you ever want to sell that gold, or let's just say you're holding gold because you believe that there's going to be some type of zombie apocalypse or something like that. And so if you have gold, especially gold bars or something, and you need to go and buy groceries, how are you going to chip off a little piece of that gold bar, or how are you going to do this? So I would suggest that you get them in the small increments, possibly coins, things of that nature, but think far ahead, like the actual scenario that you're preparing for. Now, number 4 is a little bit controversial, but it definitely has to be talked about if we're talking about gold, and that would be Bitcoin. Bitcoin's absolutely part of the weak dollar conversation, but it plays a different role than gold or foreign stocks. Think of it as a high volatility monetary hedge. That's the environment where hard, scarce assets tend to rise. And Bitcoin's whole thing is that there's only ever going to be 21 million of them. And so that's a very fixed supply, whereas with money, as we've seen, they can just print more and more of it. So when confidence in fiat drops, they're looking for other places to put that money, in places where they aren't just going to print more money. Gold is the old school hedge, and Bitcoin is the digital scarcity hedge. And historically, major Bitcoin bull runs have happened during loose monetary cycles, liquidity expansion, and falling real estate rates. That overlaps heavily with dollar weakening environments. But here's the key difference versus gold. Gold is a stability hedge, Bitcoin is speculative and a hedge hybrid. Gold moves slower, Bitcoin moves violently. Gold is a central bank asset, Bitcoin is a risk asset in the short term. Gold is defensive and Bitcoin is liquidity. In the short term, Bitcoin often trades like a tech stock on steroids. If markets panic, Bitcoin can drop with risk assets even if the dollar is weak. Long term, if people fear currency debasement like they are now, Bitcoin narrative strengthens. A weak dollar equals confidence erosion in US monetary dominance. Gold protects wealth, and Bitcoin is a bet on a new monetary system gaining trust. Number 5 would be commodities. Most commodities are rising just like gold because the US dollar is dropping, and they become cheaper for non-US dollar buyers. I would very much stick to ETFs here. DBC for broad commodities, PDBC, which is a commodity strategy ETF, or even XLE, which is energy stocks, and this is an indirect play, but still in that range. Number 6 is one of my favorites, and this would be real assets. Obviously, a weaker dollar equals much higher inflation risk. Assets that benefit would be real estate, especially with fixed rate debt, infrastructure, and then REITs tied to physical assets. A couple of ETFs to look at would be VNQ, which is a REITs ETF from Vanguard, and IGF, which is the iShares Global Infrastructure ETF. But I really rather having the actual real estate or having the actual asset tangible that I can touch, I can see. I like diversifying my portfolio with real estate, specifically in rental properties, but that's up to you. So now what typically suffers in a weak dollar? That would be long-term bonds, purely domestic small caps, and cash. Cash savings definitely lose purchase power. So now if I was gonna build out just a perfect portfolio with the actual percentages for these assets, this is how I personally would do it. This is going to give you some hedge against inflation, it's gonna give you hedge against the weakening dollar, the debasement, all these different things. And depending on your risk profile, you could add or subtract from the percentages that I personally would do. So for international stocks or the ETF VXUS, the allocation there would be 10 to 20%. For US multinationals, maybe something like VTI or maybe even VGT, 40 to 50%. In gold, like GLDM, I would do about 5 to 10%, Bitcoin, 5 to 10%, commodities with DBC, I would say 5 to 10%, and then real estate, like rental properties, 10 to 15%. As far as cash is concerned, I would have minimal amount. Remember that cash is the thing that's going to be losing the most amount of value. And so the people that hold a lot of their net worth in cash, I really think over the next 5 years or so, you're gonna see a huge drop just because of inflation, and your purchasing power is really gonna go down. The best way to hedge against inflation is to own assets, like we've been talking about in this video. Even if it's not foreign assets or all the different things that I've been talking about, you just want to be buying assets that generally have been appreciating. Things like ETFs, real estate, gold, and in my opinion, Bitcoin. Big picture, a falling dollar usually happens with high US deficits, easier Fed policy, and rising inflation expectations. With the new Fed chair coming in and expected to bring down rates big time, this could absolutely mean that higher inflation. All of those things sound like exactly what's about to happen right now and what we're kind of in right now. You want hard assets, some foreign exposure, global revenue companies, and maybe even a speculative play at a new form of money or at least a fixed supply of it with Bitcoin.